Hi, greetings everyone. So this is the first lecture of chapter number 14. The name of the chapter is Choosing an Appropriate Investment Strategy. So yes, we will look at investment strategies for institutions and individuals, and how do you decide, what factors do you consider while choosing an investment strategy. So it's all about the number of factors. So one thing I'll give a heads up to you about is this chapter involves a lot of questions. Whichever questions do come from this chapter, there are many points, many factors, many ideas, many opinions. Basically, if it is a 8 mark question, you can end up writing 25, 30 points as well for the same. So lot of content have they are completely open-ended questions. There is no such restriction, basically no restriction. You can frame as many points as possible. Whatever comes to your head might be correct. So yeah, it's a completely open-ended chapter with a broad variety of topics, broad variety of ideas that can come into picture while deciding an appropriate investment strategy. So on a scale of 0 to 5, I would rate this chapter as three basically kind of medium difficulty level, medium lengthy. So it's not so long but not so short. On a medium level of length is this chapter, and on a medium level of difficulty. But like I mentioned, these two are important points. So wherever when we look at any questions and when we look at points, those points won't be restrictive. There might be always 4, 5 other points as well that might come along with whatever is written in the study notes. That again will depend on what case you are getting in the exam. So it might be case specific, question specific points. Okay, so that might still keep on coming in. The quote of the day is, it never gets easier, you just keep getting better. So yes, we are still on chapter 14. It's not an easy journey down the road till chapter 38, but still, look at the positive side. You are getting better. You are done with 14 chapters. I don't know, after some time, you'll be done with 20 chapters, 50%. So you will keep getting better. CP1 will never get easier. It's just a long journey for us to keep getting better and better and better and give our best try. But CP1 will never get easier. So yeah, a relatable one, a relatable quote to our journey. Okay, so this is the overview as such. There are just four major sections in this. So starting with institutional investment objectives. Then also we'll look at factors influencing institutions' investment strategy. So what are the objectives, right? So why do they invest? The investment objectives, the risks for these institutional investors, what do they face, and how is their investment strategy influenced? And the last one is about individuals. So individuals is just the last section. So these are the four main sections that this chapter will be covering. Um, Starting with the first one, institutional investment objectives. So we are looking at objectives of why investors make their investments, right? What are the objectives behind these investments? First thing, first thing you should know that risky investment, okay, risky investment should have a permitted degree of risk as well as required return and cash flow timing. So if you are entering into a risky investment, then the level of risk that you are undertaking, the expected returns should be more or less in line with the additional risk that you are taking. Higher the risk, higher the expected returns, and over and above that as well, the cash flow timings the cash flow timings should be kind of matching with that of the liabilities. So that is another thing. Okay, starting with the objectives. What are the objectives of institutional investors? Ensure security of their funds. They have huge surpluses, 100 million, even $100 million, $500 million. So they have huge surpluses, huge profits. They are planning to invest it. They will want to ensure the security of their capital. Whatever, let's say they have invested 100 million, they want this 100 million, the notional, the nominal value to be secured. If they invest in equities, this 100 million might get wiped out to 50 million as well. You might lose the capital, You might not achieve any return, so that can also happen. But if you're investing in fixed income securities, this capital might be safe and you might get additional return over and above this as well. So ensuring security is just one objective. Achieving high long-term returns. If you are thinking 3 year, 5 year, 10 year horizon, they would want to achieve higher long-term returns. These objectives should be clearly stated and quantifiable. What does quantifiable mean? They should be there in terms of numbers, limits, kind of measures, which can be quantified, which can be computed, right? You can't say, see, there are two statements. If I'm the boss, if I'm saying I want high returns, okay, that is one statement. And I want 20% returns. That is another statement, right? Both are way too different. Second one is quantifiable. I want 20% returns is quantifiable, and my investment managers and everyone will work accordingly to get 20%. If I say I want high returns, then who will know what high means? High could be as high as 50% as well, and high could be 10% as well over and above inflation. So yeah, no one knows that. So objectives should be clearly stated, listed, and quantifiable, and they should be documented and known to everyone. One of the objectives is to meet the liabilities as they fall due. Okay, so this happens in case of us as well, as individual investors. Suppose you are getting a salary of 1 lakh rupees a month. You got the salary, and within the start of the month only you spent a lot. Within the middle of the month you saw that stock markets are down, you invested in those markets. Then you saw a bond issue opening, a new issue of bonds which is opening, and interest rate was high, so you invested in this bonds. And now your fund, your account, your bank account balance is at almost the minimum, and now you have a credit card bill due. How would you pay it, right? Your bank account balance is roughly at minimum, which is 5k, and you have a credit card bill of 20k coming up. So before you get your next month's salary, how would you pay? So the liability is high, but you did not manage your assets. You spent it in the first week itself. You invested in bond, you invested in equities, so you blocked all your money and did not care about your liability, right? So you invested. See, investing is good, but you should invest considering your liabilities, right? Because if you have a liability, if you have a credit card payment due, then you should not have invested in equities or bonds. You should have kept that many funds aside, right? But you did not. You went ahead with the investment opportunity, you invested, blocked all your funds, and now you don't have any funds to pay the liability. So you can do it because your amounts are very less. What if I multiply both these amounts by 1000, right? In that case the amounts become higher. In that case, if we are looking at from the company's point of view, company can't do that, right? Company has to take care of what future liabilities it will have, and accordingly invest their assets. If it invests most of its asset into a bond, a fixed income bond for 5 years, all the money is blocked. And whatever, what suppose if some liability arises, then company can't break that investment and pay off the liability, right? Company now needs to take out a loan or some other approach to meet that liability, which will create more liability. So that is just not accurate from company's perspective. So institutions will ensure that whatever liabilities that they have sufficient assets to meet them, and only whatever extra assets that they have, okay, extra cash, extra money over and above those liability amounts, that is what they'll use, or that is what they'll invest or block it. They won't block every of their all their money in a bond or in equities or in properties or in any other asset. They'll keep some cash in their bank account. They'll keep some bank balance with them as well to meet these liabilities. Control the incidence of future obligations of a third party, like employer's contribution. So again, these are again monthly liabilities, periodic liabilities, contingent liabilities, normal creditors. So all the liabilities will be accounted for. It is the same as the above point. Need to demonstrate that sufficient assets are available to meet the liabilities as they fall due on a realistic basis and statutory basis and on a discontinuance basis as well. So, okay, this is a big statement. So, you need to demonstrate for an internal perspective, okay, internal reviews and everything also happens. So you need to let the shareholders and other stakeholders know that your assets are significantly higher than the liabilities, and you will be easily able to meet those liabilities on a realistic basis, that is internal assessment, on a statutory basis based on external regulators requirement. If the external regulator says to compute, to check whether your assets are enough or not compared to your liabilities, then you will check on a regulator assessment as well, and on a discontinuance basis. Suppose if you are defaulting tomorrow, that is a discontinuance basis, right? If you are defaulting tomorrow, then in that case, what would be the value of the assets and the liabilities, and would those assets be enough to meet the liabilities or not? So these are the three cases, and we know, right? I'll just clear everything. If we are looking at realistic basis or internal assessment, what assumptions will we use? Normal assumptions, like normal realistic assumptions. If we are looking at regulatory requirements, we would be using something known as prudent assumptions. Okay, we would be using prudent assumptions, safer assumptions. We won't expect returns to be 10%. We will expect returns to be 6, 7%. We will expect higher inflation. Basically, a little bit worse scenario. Okay. We saw in a base case scenario, optimistic scenario, and adverse scenario. This regulatory scenario won't be very adverse. It would be a little bit adverse, kind of a prudent. Prudent is the best word. Keeping some buffer, and just giving an example, when we look at growth rates, earnings, dividend levels, asset growth, whatever, everywhere there will be prudent assumptions. Like there won't be very high or very optimistic assumptions, but worse than normal. Okay, not normal, not realistic, not base, little bit lesser than base, little bit on the safer end. Okay, and discontinuance basis is the worst case where you will default and using all the worst assumptions possible. In that case, the asset values will be at their lowest and liabilities values would be at their highest. So in that case, are you able to meet the liabilities or not? That is discontinuance valuation or using a discontinuance basis. This is what we looked at in chapter number 12. Don't forget it. Oh, sorry, 13. Okay, hold on. I'm not sure which chapter. 12, 12, 12, 12, not 13. 12, my bad. Chapter 12. Uh, okay. Achieving a pre-specified target level of return. That is the objective, right? Again, you are targeting 20%. That is pre-specified. Achieving that is the objective. Matching or exceeding competitors. So if competitors are earning XYZ return on their investments, then we should at least earn that or even earn higher than what they are earning. We should be performing better than how they are performing. Okay. So in every aspect, in case of insurance business, in case of banking business, wherever, if we are choosing your investment strategy should be such that the risk should be lower and the returns should be as high as possible, and possibly greater or exceeding those of the competitors. So that is just one area. Tracking an index as closely as possible. So if your objective is to track an index, maybe a Nifty index in India, like a Jakarta index in case of Indonesia, Jakarta Composite, right? If I'm not wrong. Uh-huh. So if you are planning to track any index, then in that case you need to track it as close as possible. If Nifty or if Jakarta, if they are giving 25% return, then your investments or your assets should give around 24 or 26, right? Around 23, max to max. There will be a tracking error. All those things now, matching a index and everything, we'll look at it in chapter number 16. So don't worry, tracking error and all those metrics will also come into picture. But matching this 25% as close as possible. If another year this falls by 25%, then your investment should also fall by 25%. It should be like a very close match. So whatever is happening with the index or with the market index in India, Nifty, in Indonesia, Jakarta, in US, S&P 500, Dow Jones, or even Nasdaq. Nasdaq is not a better thing. Nasdaq includes mainly IT, Dow Jones 30 is again also not reliable because it includes only 30 stocks, and the computation of index is based on price, not market cap. So you know how index values are computed. So all that you will find it in SP5 and SS7, but SS7 specifically, I don't want to go into detail in that. But so generally, S&P 500 is what is being used as index for US. In case of UK, it's FTSE, FTSE. So track and index as close as possible. Now moving on to satisfying statutory solvency requirements. Okay, so if you have some solvency requirements, if you require XYZ level of capital by your regulator, then you should be able to meet those. You should be able to satisfy those, right? So that is another thing. Framed in terms of risk, total required return, and cash flow timings. So correct again in terms of risk, level of risk that you are taking, total required returns, and cash flow timings. When would you be earning those cash flows, and are those cash flows used to match any liabilities or not? So these are the objectives. Again, the objectives are not limited. If you are an insurance company, then there will be a little bit more objectives as well. If you are a pensions company, there might be different objectives. Again, if you are an IT company or any other non-financial company, your objectives would be also different. So based on how the question comes, you need to add these as possible. So these are general ones. This would still come over and above these, whatever the question demands, whatever the case states, those objectives would be coming in. So hope this is clear to you. We will move on. Okay, just a definition of what does the risk mean. Okay, there is something you might have heard about risk and uncertainty, right? What is risk and what is uncertainty? Uncertainty is that you don't know if the event is happening and you don't know the timing of it. Okay, you are not sure of the event happening and you are not sure of the timing of it happening. Example, natural calamities. In case of risk, you are sure that the event will happen, but you are not sure when it will happen. Like insurance, in case like death, you are sure that is going to happen. Everyone will die. There is no such research done to increase mortality or to make everyone immortal. But so everyone will die, but no one knows when, right? So that is risk. But uncertainty is you don't know if you are going to die or death. In that case, there is no uncertainty. In case of natural disasters, man-made calamities, there is uncertainty. So you don't know if it is going to happen or not. And if it does, you don't know the timing of the same. So there are two unknown things. Risk, there is one unknown thing. So in case of investments, what does risk mean is what we'll look at. So it is used to describe the probability of investment failing completely. Okay, failing again. Now the word failure, we will look at it later. That this is with regards to investors or institutions' own perception. If their required level of return was suppose 10%, 15%, whatever, and you are not able to earn that, you are not able to earn the risk-free rate, you are not able to earn positive returns, you earn negative returns, something like that happens. In that case, the investment has failed. So it's the risk or it's the probability of investment failing. Okay, it's the probability of your investment failing completely. More frequently, it is used to signify the expected variability of the return from an investment. So, what is the variability in returns? So, if you know how do you compute the variance of returns, take any stock, take 250 or 300, 365, whatever, 250 are the number of business days. So, take 1 year of data, you will get roughly 250 historic prices, compute returns on it, you will get 249 returns, right? And then take a variance of their returns. So you will automatically know what is how much the returns fluctuate, right? You can arrange these returns in ascending, descending order. You can find what is the highest level of return, what is the lowest level of return. So this will also help you to get the expected variability. So this is the risk. So if I apply the standard deviation function, standard deviation on these 249 returns, then I will get the volatility And according to CM2, risk is the volatility of the asset. Okay, so risk is equal to volatility, which is equal to sigma. Okay, so yes, variance is sigma square. Variance is not risk. Volatility is risk, which is just sigma. So yeah. So to be more precise, while defining investment risk, we need to consider three things: the time period, whether returns are measured in real, net of inflation or nominal terms, which currency would we be measuring the returns? So and other various factors as well, but mainly it is time period, nominal or real returns, currency in which we measure returns are the things that we'll consider to define risk, to define investment risk. And again, it's just a random slide. Okay, this slide is just a random slide. There is no such thing that they'll ask you in exam, but it's just a definition of what risk is and how different investors and institutions have different perceptions about this risk. Okay, so it's just a definition-based slide. Exam, there are almost zero chances of this coming in exam, but still we just are going through it. But that's it. It is difficult to say whether or not an asset is risky unless we know the specified objectives of the investor. So if we don't know what the investor wants, if we don't know what his requirements are, we would not know if the asset is risky or not. Some people think equities are risky, some people think they are just normal, some people think cryptocurrency is risky, some people think that cryptocurrency is normal, it's not risky. So again, it's based on investors' perceptions and something known as objectives of the investors. So whatever the objectives of investor are, based on this, the asset would be classified as risky or not risky. So most practical definition is probability of failing to achieve investors' objective. If your objective is to achieve 15% return, if our objective is to achieve 15% return, if equities are able to achieve 15%, you will consider equities that's not risky. Okay. If cryptocurrency you invest, if they are not able to achieve 15% return, you will consider cryptocurrency as risky. So if your objective is met, if you are happy at the end, you will not consider that particular investment as risky. You will be like, okay, it's normal, it's not risky. And but if your objective is not met, then in that case, you will surely consider it as risky. And that's how categorization happens. So, hope this is clear to you. Okay, so we'll move on. What will the risk appetite of an institution depend on? Okay, so every institutions have some risk appetite. They set up a number. Let's say 20% risk is what they'll take. Let's say 30% is what risk they'll take in terms of standard deviation, in terms of volatility, or in any other area for different assets, different products, different type of investments. They have various risk appetite limits set up. So how does this risk appetite limit will be determined, and what will it depend on? Nature of institution. So if it is a bank, if it is an insurance company, then the risk appetite will be comparatively higher compared to a IT company. Okay, IT company in a risk appetite would be a bit lower. But again, we can look at it from different angles as well. If we are considering some other giant company like Microsoft, Apple. So their risk appetites are very, very high because again, these are giant companies. They have a lot of cash in hand and they do mergers. They acquire a lot of other companies. So their risk appetites are very, very high. Um, Again, the more safe the institution, if it is involved in just one area of work, if it is a smaller company just trying to grow, in that case, risk appetite, it will prefer to take less risks. If it is governed, if it is tightly governed by the regulator, right? Regulator in case of insurance, banks, in case of mutual funds, then in that case, risk would be lesser. So yeah, nature of institutions will decide how much risk a company would be taking. Constraints of its governing body and documentation. So again, governing body, who is governing this company? So which regulator is it, and what documentation and what rules and laws are following this investment strategy? So that will decide the risk appetite. Legal or statutory controls. So legal controls is basically if you are a bank, you are using deposit holders' money. So in that case, it's a liability, right? If you look at the bank's balance sheet, what is the liability for banks? Deposit holders, FDs, and whatever money that deposit holders have deposited with the bank, that is the liability of the bank, because bank will need to pay up those deposit holders someday or the another. In case of assets, all the loans that they have given. Okay, so if a bank has given XYZ amount of loan, so that is an asset because that loan will be repaid and it's kind of a receivable for the bank. The bank will get the amount sooner or later, so it is an asset for the bank. It is a receivable. Okay, probably in future it will be settled and received. It is a receivable from bank's end. So those are assets, and deposits and everything are liabilities. So if you are using the deposit holders money to take risks, then that is probably legally and statutory not right as well. So you might not be able to take way too high risk, not be able to invest in assets like crypto and some other overseas assets as such. So that automatically will reduce the total or net risk that you are taking using some other people's money. Risk appetite of key stakeholders. So again, who is the MD, the managing director? Who is the promoter of the company? What is the risk appetite of the promoter? Then who are the other stakeholders, other investors? What are the subsequent risk appetites of all of those investors and key stakeholders? So based on each of their risk appetite, automatically the risk appetite of the institution will decide, because end of the day, who will be sitting in these board meetings, in this board meetings, in the AGMs, in the AGM that happens, who would be deciding company strategies? All these key stakeholders only, right? So if their attitude is kind of risk seeking, then the risk appetite would be higher. But if their attitude is kind of risk averse, if they are thinking conservatively, in that case, risk appetite would be lower. So as simple as that. And trustees. So again, in case of unit trust, pension companies, there are trustees to hold or secure these assets. So based on that as well, the risk appetite will depend. So a lot of other things as well which could be come into picture. The presence across overseas, if the company is present in overseas markets or not. I'll just keep adding here two, three more points, which could be added depending on the case. Okay, if the case says that the company is overseas, then if it is presence across overseas, then automatically risk appetite would be higher. Here, in nature of institution, we can divide it as which industry it is from, and whichever industry it is, the size of the institution. The bigger the institution, the more the surplus for the institution. The bigger the institution, in that case, higher would be the risk appetite of that particular institution. So again, these are just again one two other points as well that could be added. So yeah, these are the factors on which the risk appetite of the institution would depend upon. We'll move on to the factors influencing the investment strategy of the institution. Okay, so institution strategy, how is it influenced, and what are the factors which are influencing? So we'll just read the factors. It's not something very new for you, but you will automatically understand. Um, Nature of existing liabilities. So again, nature is basically, are they certain or are they uncertain in nature? Are they fixed or are they variable? So based on the nature, is the term of the existing liabilities is also their term. So are they 5 years, 10 years? What is the term? Then are they fixed or variable? Then there'll be a timing of cash flows. Okay, timing, is the timing certain or uncertain? Like, will the liability come to us in 1 year, or is it uncertain? It can come to us at any point in time. So liability can arise at any point in time. Basically, is it certain in time or is it contingent? So that is also one area. Then currency of existing liabilities. So again, which currency are they denominated in, and the level of uncertainty, like I mentioned, level of uncertainty would involve certainty in cash flows and certainty in timings as well. So that also needs to be taken into consideration. So all this is with regard to the liabilities. Okay, so all these factors are with regards to the liabilities that should be taken into consideration while selecting the institution's investment strategy. So future accrual of liabilities. So what does this mean is, if your current liability, let's say, is $1 million, will it keep on accruing, right? Will it become $1.1 million after 1 year? Will it keep on increasing or not, right? So how do you accrue your investments? Your investments are, let's say you invested you invested 10,000 rupees. So in that case they'll become 11,000 after 2 years, 3 years, whatever. So you'll keep on getting added, your investments will keep on growing. So are your liabilities also growing? Are they accruing on some level? Okay, so that is the important thing, because now you will think, okay, the liability is only suppose $10 million, but who knows, after 1 year the same liability will be 11 or $12 million. So it is keeping on accruing, it is keeping on growing. So in that case your assets should be selected such that even they keep growing, and they match whatever the liabilities are there. So yeah, tax and expenses need to be considered while selecting an investment. Statutory, legal, or voluntary restrictions on investments. So there will be restrictions in overseas assets. There will be restrictions in crypto. Will be restrictions on equity as well. Like suppose something like you can't invest more than 30% of your assets in equities. So always equity should be less than 30% of your total assets. You have to compulsorily, voluntarily, you have to mandatorily invest 15% in government bonds or government securities. That also can be a restriction or a regulation. So in that case, compulsorily 15% will go into government treasuries, government bonds, and government instruments, GSEC securities, and 30% maximum 30% cap on equities. So you invest around 30% or 25%, whatever, in equities. So this is how you will frame. So there'll be restrictions on statutory, legal, or voluntary restrictions as well. Accordingly, you will decide how your risk appetite, and you will decide which are the factors which will influence this long-term investment strategy. So, okay, one thing I'll just out here update is, just give me a minute. Here, what will the risk appetite decision correct? What will how would the what are the factors? What are the factors affecting the investment strategy of an institution? Okay, yeah, that was just an error. So hope this is clear to you now. And till here, we just saw all the points. So these 5 points initially are with regards to liabilities, the nature of liability, the currency, the level, the future, the term, all those things about liabilities. Then taxes and expenses, then statutory, legal, or voluntary restrictions on investments. So different type of restrictions on investments, and accordingly your investment strategy would be like size of assets in relation to liabilities. If assets are two times that of liabilities, okay, if assets are two times that of liabilities, it means that you have a lot of free assets. Okay, you have a lot of free assets. In that case, you can just invest according to your own needs, because you are already covering up all your liabilities. There won't be any scenario where you are not able to meet your liability requirements. So what you will do is keep the, suppose liabilities are 100 million, your net assets are in this case 200 million. So what you will do is you will try to match this 100 million liabilities with 100 million assets. This is kind of matched, and you still have extra 100, which you will invest according to your own desires. If you want to take higher risk, then you will go and take higher risk. There will be investments of longer term as well, 15, 20 years. You will block that money. You will invest in properties and any other asset that you can feel like, because you have this free assets. You have these assets over and above your liabilities, which are extra. So in this case, you can do whatever you want. Expected long-term return from various assets. So based on that expectation, you will decide your investment strategy, the accounting rules for the same, statutory valuation and solvency requirements. So now when we look at statutory valuation, in some cases, the regulator has different methods of valuing different assets. Okay, so in some cases, let's suppose property valuation. Suppose, and this is whole a hypothetical example that I'm creating. Property valuation, what regulators suggest is to discount rents, future rents, and get the value of property. But when you actually discount all the future rents to get the value of property, it comes out as very less. Okay, the actual value of property is suppose you have paid 15 million for the same, is the value of the property that you have paid, and 15 million is what your broker is quoting, what everyone in the market is quoting, 15 million. Okay, that is the value of the property. But in when you use the valuation approach, the statutory valuation approach decided by the regulator, which is a discounted cash flow approach for the properties, then in that case you have to discount all the future rent incomes to the present value, while after discounting the valuation is coming as, let's say, $8 million, which is very less, right? So your assets are understated now. So you will automatically know that if you invest in properties, this is what is going to happen. Your cash will go. So your out of your bank, 15 million will go. The value of the asset is 15 million. When you sell it, you will get 15 million. But just because of this regulatory valuation approach, the value of this asset will only be considered 8 million. And now because it's automatically considered as a loss of 7 million, right? So if your asset is understated, in this case, probably it might be the case if you have invested a lot more in properties, then in that case everything is understated, then you might not be able to meet your liabilities as well. So why to do so, right? Because it's just that you are investing 15 million and your value that is coming out is 8. Only 8 is considered as your as your asset in the balance sheet according to regulatory requirements. Then it does not make sense to invest in properties at all. You will invest in other assets. You will invest in quoted instruments which have a quoted market value, which have a better approach of regulatory or a statutory valuation, and you are getting a better price of the same. So based on this, you will invest. Existing asset portfolio. So this is very important. When we look at existing asset, okay, even from institutions point of view, even from your personal point of view. So suppose if out of your portfolio you have invested 80%, 85% in equities, okay, and now again you have more money left to be invested, would you still go for equities? You would be like, no, no, equities is enough. I have invested already so many in equities. I'll try maybe little bit more into bonds, and even if I've invested in bonds, still I have extra money, then you'll be like, okay, let's take risk, let's go into crypto. So based on your current asset portfolio, you will invest. So if the company already has a good exposure in the domestic economy, in case of domestic bonds, government bonds, equities, and everything, and still has a lot more money, then our company will think of diversifying and probably moving on to overseas assets if permissible. If permissible, if it is not permissible, then again you still have those restricted number of assets within the country only. But if permissible, you will move on to overseas assets as well. Strategy followed by other funds. Again, this is also what we will look at, what competitors are doing, how they are investing, what approach that they are following. Can we follow the same approach or not? So all those things also we will consider. Institutions, risk appetite, institutions, objectives. We just saw both of this in section 1 and section 2. So based on this as well, the fact investment strategy would be chosen, and need for diversification. So is your portfolio concentrated into few assets? If it is, then in that case, you need to diversify. If it is already diversified, then probably you might still keep investing in all the classes on a proportionate basis. So based on the current diversification, based on the current existing asset portfolio, and lot of factors. So like you see, we have roughly around this 5, 10, 15, 18 points out here. Still, this 18 are not enough. There can be 36 as well. There can be more 18 points as well. So it is a never-ending list. What factors would affect? So simple example, we can look at qualitative factors. Always consider after you are done with the main important bits. Always consider qualitative factors. So what are the factors affecting your investment strategy? Basically, CEO's judgment, decision by the board of directors, CEO's judgment, board of directors' decision or stakeholders' decision. So that might also affect the investment strategy, right? It's very simple. If they decide to invest in XYZ asset, then how will it change? What are the factors affecting? Probably some new asset class, new investment opportunities. So if in the market there are very various new investment opportunities, then you would go for those opportunities, right? Rather than just continuing with the current one. So all those things also, like I mentioned, if you just pause this on this screen, if you run your mind to function, you can automatically add around 5, 10 more points as well. Which again, it's not right, something is right or something is wrong, but still that also might be a point. Simple example, you can consider yourself. How do you select an asset? Why do you invest in a particular asset? Right. Similarly, look at it from the institution's perspective as well. Why do you invest in a particular asset? How can they match the liabilities? Are they looking at other institutions as well? So here we mentioned something about competitors as well, right? What the competitors are doing, what the other funds are doing. So accordingly, if the other funds are following XYZ approach, this company will also try to follow that same approach, because see, they don't want some risk, right? If everyone in the industry is following approach A, okay, that is approach A, basically allocation and less allocation in equities, more in bonds, something like that. If everyone is following a particular approach, and if you follow some different approach, and if you do a loss out of that, then everyone will keep pointing fingers at you. Your stock price will get hammered, the board, everyone will be criticized, you will be under news. Everyone will say, everyone in the industry is following the same approach. Why did you take a risk, and why did you go with something new, right? But if you make a profit by doing something new, then everyone will again like you. So it's not that it's just a decision that you need to take. So yeah, so if again, it's just a decision. So if you are taking a decision, doing something new, if you succeed in it, then you will get good, all good news around you. Everyone will start liking you. Your company's prices will boost, and everyone will show interest in your own company. So that is if your decision succeeds. But if you take a decision, something new decision, something big decision, if it fails, then you are there to take the blame. You have to take the blame. So yeah, all these things are basically factors which affect your institution's investment strategy. So what I'll do is, with this, I'll just end my lecture one out here. And in lecture two, we'll continue with institutions investment strategy. We'll look at how the portfolio can be diversified. What are the risks of mismatching assets and liabilities? So if you try and mismatch, okay, mismatch is basically that you are mismatching the term, you are mismatching the currency, something like all your suppose most of your liabilities are in US dollars, but your assets are in INR. So that is a mismatch. So what are the risks of the same is what we'll be looking at, and we'll look at institutions investment strategy as well. So I don't think this will be completed in the next one lecture as well. We'll need two more. So yeah, this is just the first lecture of it, and there'll be two more lectures coming forward. So thanks a lot for watching this lecture with me. If you have any doubt, you know what to do. Feel free to reach out to me or anyone else on the group, and we'll help you solve the doubt. And if if someone reaches out on the group with a doubt, whoever sees it first, if you know the answer, try to put the answer on the group. Don't wait for me to respond, right? You all might also know it. If some of you, there are currently the batch size is 7 or 8, right? If some of you puts a doubt on the group, then in that case, any one of you who sees it, and if you know it, try and answer it, try and solve it. Even that will give you a tough, a kind of exercise. That's a tough test for you, how to answer someone's doubt. So if you are able to answer it well and good, then again, I am there to provide the inputs at the end. So yeah, any doubts, reach out on the group. And thanks a lot for watching this session. Thank you very much. Bye bye.